down? Up, down, sideways?
Down.
Is it down? By how much?
1.35%.
Oh, really? That's a pretty big move. Any idea why the market kind of sell off or what's going on in the marketplace? That would.
It says oil fell.
Oil fell. Okay. Do oil companies make up a significant portion of the stock market indexes? Do energy companies make up a significant portion of the stock market indexes? Yes. So if oil goes down, what's the assumption on oil company revenues? Down. What about earnings? Down. Earnings growth? Stock prices? Exactly. Okay. Anything else out there that would cause the markets to be a little jittery?
The election.
Samsung, discontinued the Galaxy 7 because they were blowing up.
It says healthcare also.
Healthcare costs.
Sure.
Healthcare costs. So if Trump comes in, do you think that his constituencies in the Senate and the House may go back and repeal Obamacare? Would that be a major disruption to individuals and their ability to consume and invest
Yeah.
and save? Yeah. Okay, so there might be a little bit of that. Any other news? Huh? Gold's down, so there's a sell-off in gold, but you would think that the money would go into stocks, but they probably went into bonds. What's happened on the 10-year Treasury yield? Is it up or down?
It's up.
It's up to
It's
what?
It's up 0.02%, I think. 2.2%.
Yeah, to what? What's the yield to maturity on the 10-year Treasury right now? Which is the benchmark? 1.75? Okay. And where was it when we first started this class? It was 1.3, it's at 1.75, so how many basis points is that? Almost 50 basis points, maybe a little less. Is that a pretty big move? If interest rates are rising, what's happening to bond prices? If interest rates are going up, what happens to bond prices?
Down.
They go down. And what happens if the 10-year Treasury yield and interest rates rise rapidly? What happens to stock prices? They'll probably go down too. Okay. And where's gold?
Down.
Yeah, what's it trading at? Because I think in number terms.
1,257.
Okay, so 1257. Where did it peak? And can you give me the percentage change calculation? Did it peak at like 1,300 and it's at 1,200 roughly? What's the percentage change drop in from 1,300 to 1,200? What's the percentage change? And you're going to need your calculators today. So if you can pull out your calculators and start running the calculations, this is really good practice to be able to do the analysis that you're going to put into bullets in your memo. Okay? Because I want to see analysis. So what's the percentage change drop in gold from 1,300 an ounce to 1,200? What's the percentage change? Okay, so roughly 8%. And then what about oil? When we first came into class, what was oil trading at per barrel? It's like 44, something like that. Let's say 42. Where's it trading now? 50.76. And what's the percentage change difference between the two? So 50 divided by 42 minus 1 times 100. What's the percentage change difference in oil since we walked into this class at the beginning of the year when we started placing some of those trades? So what's the percentage change? We'll just do 50 divided by 40. The change in 50 minus 40 divided by 40, 19, so almost 20%. So oil's seen roughly a 20% move since we first started the class. Is that a pretty big move? Is that a pretty big move? Yeah, and what's the reason why that happened? Do we know? What was the impetus?
Was it OPEC that decided to limit production over the next quarter?
Yeah, exactly. OPEC didn't they have a meeting? Russia showed up, Venezuela, Iran, some of the oil producing countries all got together to basically come up with an agreement to cut production. Right? That's what they did. All right. Biggest news, dollar to the pound, dollar to the euro. What happened to the pound over the last week? Anything? Anything happen to the pound? Yes, no? Do you care?
It dropped 2%.
It actually dropped around 7% in one day. Is that a lot?
Yeah.
Yeah, it's a huge move in one day. It's a flash crash, okay? So over the last, since the announcement of Brexit, how fast has the pound depreciated? What's the percentage change in depreciation in the pound compared to the dollar since they announced Brexit?
Right, currently?
Yeah, since Brexit announcement to today, what's the percentage change drop, percentage change in depreciation between the dollar and the pound? And where is it right now? What's it trading at?
Is that
What is it?
123?
Yeah, 123, okay. And where was it? Wasn't it around
155.
155? So what's the percentage change? You have to be able to know how to do percentage changes. So what's the percentage change drop since the Brexit, the dollar to the pound?
6%,
How much?
I think 26.
That's a lot. Is that a lot? Yeah, that's a lot. So what does that make UK or British exports more or less expensive? Less expensive, okay? Is that going to stimulate their economy? Yeah. And what does that do to imports? If your currency is devalued or depreciated 20-something%, what does that do to imports coming into the country? Makes them more expensive. Is that going to be inflationary or deflationary? It's inflationary. And what does inflation do to standards of living? Does it make them go up or make them go down?
Down.
Down. Okay, so are they better off or worse off? You ask them. So if you were holding your assets in British pounds and your currency devalues 15%, are you more or less wealthy? You're less wealthy, right? Because right off the top, due to currency, the value of your assets are down 15 to 20%. Okay? So that's going to have a major wealth effect. And Theresa May did come out and say, we are leaving. We're leaving as soon as possible. Okay? No negotiation. We are going to decouple from the European Union as quick as possible. Is that good or bad for the pound? Bad. Right? It's bad politically. Okay? So self-inflicted political wounds. All right, so we went over the Dow, we went over oil, we went over gold, we went over bonds, and we went over FX. Okay, excellent. So I'll ask you more of those again, because it's really, really important. We're in an interesting place in history right now in the markets. And then how many days do we have left for the election? Yeah, so less than 30 days. So you think there's going to be more or less market volatility in the next 30 days?
More.
Probably more, right? Does it matter who the president's going to be and who controls both houses of the Congress and who replaces Scalia on the Supreme Court? Is that going to matter? Yeah, so the market doesn't know what they're doing. I mean, they're trying to figure it out. So you're probably going to be looking at more volatility across all of the major asset classes over the next 30 days. Now, do traders like volatility? Yeah, they do. They can trade it. What about institutional investors that are buying holders? Do they like volatility? No. So we'll see what happens. All right. So who's going to be my timekeeper? I need a timekeeper. Okay, great.
We have a stopwatch on.
So how much time do I have?
An hour and 19 minutes.
Okay, perfect. I'll be able to get through it in that time. Okay? And then can you give me, like, after the hour, 50, 40, 30, 10, 5-minute warnings so I can time myself and make sure I stay on track? Okay, thank you. All right. So what we're going to do now, and I would take notes on this, even though I'm recording it. Make sure you stay on me. You need to take notes on this, because this is going to be the in-class portion of the midterm. Okay, so this lecture, ready? So this lecture is called Financial Integration. My financial integration. I developed this about 12 years ago. And financial integration was basically in response to basically the way these courses are laid out, and really basically the way that programs are laid out, okay? And really the way that students think, okay? And what I'm trying to do is transform you from being business students to business student professionals and business student executives, okay? Thinking at that level. And the bias by students and for professors is to think departmentally and compartmentally, okay? Departmentally and compartmentally. So we basically hack up the courses within the disciplines, particularly in the finance disciplines, by basically classes, dictated the content by books, by chapters, and we basically end up focusing into a very narrow view of things. And we really focus on more of the operational aspects associated with obtaining the knowledge. We don't think strategically or tactically or how all of these things basically relate to each other. So you have to broaden your view to a more tactical and strategic level and be more organic in your view and more holistic in your view. Because what we're going to do today is we are going to pretend that we're IBM, okay? And IBM is going to raise some capital in the capital markets, some debt and some equity, and we are going to buy a multi-billion-dollar tech company, okay? And we're going to go through the underwriting process. And basically this lecture is going to overlay on top of the second, third, and the last third of the course. So I'm going to basically lay out a foundation, and then we're going to go back and drill into the specifics, but we have to lay out basically the strategic overlay, okay, for this. So what we're going to do is we're going to go through financial integration. And basically what it is, it's an integration of financial economics, finance, and investment decision making. And this is the way that senior level executives think, okay? This is how they view the world. And the first place that they're going to attack and understand is the systematic risks in the marketplace, i.e. the yield curve. Okay, so we're going to do a little review. So all debt, all equity securities, all real estate valuations are priced off of the yield curve. So you have to start with the yield curve. And the yield curve is the risk-free rate, which is the base rate, in calculating the cost of the debt and cost of the equity, come up with the weighted average cost of capital, which is going to be the discount rate that you're going to use, discount the cash flows to make the investment decision. Okay? But the base rate, the starting point, is the yield curve. And in most cases, the yield curve is upward sloping. And what's the equation that we use to calculate the risk-free rate? Fisher equation. And what's the Fisher equation?
I equals constant real rates plus inflation expectation.
Excellent. Okay. So the real rate doesn't change in the short run, in the short term, and basically movements in the risk-free rate or in nominal interest rates are driven by inflation expectations. So if inflation expectations go up, the yield curve shifts up. If inflation expectations shift down, the yield curve shifts down across the whole curve, okay? The Fed may see that the economy is overheating and start to sell off bonds and drive bond prices down and interest rates up to cool the economy. So that's going to cause the yield curve to flatten. And the Federal Reserve may oversell those bonds on the short end, causing the yield curve to invert. Once the yield curve inverts, how much time do we have until the market peaks, the stock market peaks?
12 months.
12 months. And how many months do we have until we go into a recession? 24. Okay. So with an upward sloping curve, are inflation expectations positive, 0, or negative? In an upward sloping yield curve, are inflation expectations positive, 0, or negative? Positive. Okay, excellent. A flat yield curve, 0. And a inverted curve?
Negative.
Negative. Okay, excellent. Nice job. Okay, and remember that the yield curve is the risk-free rate. Okay, and the risk-free rate is determined using the Fisher equation for US Treasury securities. And the risk-free rate is gonna be the base rate for the calculations of the debt and the equity. And I'll show you in a minute. So it's extremely important to understand movements in yield curves because they're gonna affect asset prices. So if I wanna value an asset, such as a stock or a bond, what's the first valuation method that I would use? What's the most simplistic method for valuing stocks or bonds? Assuming that the numerator is gonna be constant, the cash flows are gonna be constant into perpetuity. What model do we use? This was the last page in your exercise in your in-class exam. So what's the model called? When you're assuming that the cash flows are gonna be constant,
TV?
what is it?
TV?
Now, what's the model called?
Multiple,
No, you guys are coming up with the other ones, but we're assuming that the cash flows are gonna remain flat into perpetuity. What's the model called?
discount.
What? No, I'm giving you the answer.
Discount.
Listen to what I said.
Perpetuity model.
Perpetuity, thank you. Perpetuity, okay, and what's the perpetuity model? I'm gonna go over this like 100,000 times until you get it, okay? So what's the perpetuity model? Give me the equation.
Cash flows over,
And then what's the cash flow? What year? Are we using last year's?
T
+1.
plus one
T plus one. Thank you.
over interest rate.
Is it the interest rate or the discount rate or the expected rate of return?
Expected.
Expected rate of return. Okay. Could it also be the weighted average cost of capital or the equity cost of capital? Yeah. Okay, good. And this is gonna give us what? Value. So embedded in the expected return or the cost of capital is what? What's embedded in here? What's the base rate inside this?
Capital asset pricing.
No, we'll do that in a second. What's embedded in here?
Free cash flow.
No, that's up here. What's embedded in this expected return? What's the base rate?
Net operating.
No. I just said it. We went over it like I spent 5 minutes going over it.
Risk-free rate?
Risk-free rate, okay. So if the risk-free rate goes up, what happens to the expected return or the discount rate or the cost of capital? Goes
Down.
goes
Goes up.
And if it goes up, what happens to the values?
They
They
go
go
up.
down. Okay, what's the next model? What's the next model?
Growing growth.
Thank you. Okay, and what's the equation?
V equals
What is it?
value equals cash flow over I minus
Okay,
G.
what cash flow, last year or this year?
T plus 1
Okay, over what?
over I minus G.
I minus G. And what's G?
Growth.
Growth in what? What's G?
Rate expectations.
In what?
Rate expectations.
No.
No.
What's G? Go ahead. Go ahead.
Expected rate.
What's G? Okay, hurry up or else I'm gonna keep going. It's the constant growth rate in the cash flows into perpetuity, forever. This assumes that the cash flows are flat. This assumes they grow at a constant rate. So if we expect a recession over the next 2-3 years, what's gonna happen to the growth rate or expected growth rate in the cash flows? Are they gonna go up or down? They're gonna go up or down? Down. And if the growth rate goes down, what happens to the values?
Goes down.
They go down. Okay, what's the next model?
Multiple approach.
Multiple. And what's the multiple model?
Cash flows T plus 1 times M equals value.
All right, excellent. And what are the ways to calculate the multiples?
Price earnings.
Okay, I can use PE, but I'm not gonna use that right now. What's the second one?
1 over I
1 over I.
and then 1 over I minus G.
Okay, thank you. So if the yield curve shifts up, what happens to the risk-free rate? If the yield curve shifts up, what happens to the risk-free rate? If the yield curve shifts up, what happens to the risk-free rate?
It goes up.
It goes up, okay? And if the interest rates go up, what happens to your expected return? and your cost of capital.
It goes
If
up.
interest rates go up and the risk-free rate goes up, then what happens to your cost of capital and your expected rate of return?
They go up.
Goes
Up.
up, okay? And if I goes up, what happens to the multiple? If I goes up, what happens to the multiple? If I goes up, what happens to the multiple?
Multiple goes down.
Multiple goes down, what happens to value?
Goes down.
Goes down. Okay. If we're expecting a recession or slow growth in the future, and G is expected to be low, or fall, what happens to the multiple? What happens to the multiple if G goes down or slows? Goes down, and what happens to value? Goes down. Okay. What's the next model?
Discounted cash flow.
Discounted cash flow, DCF. Okay. Value for DCF is the sum of the cash flows, T plus N, I, 1 plus I to the N, plus, what's the next one? TV, terminal value, discounted by 1, I to the N. So if risk-free rates go up, the yield curve shifts up, what happens to return expectations?
Go up.
They go up, okay? And if the discount rate goes up, what happens to the values? Discount rate goes up, what happens to the values? Discount rates go up, what happens to values? Discount rates go up, what happens to the value?
They go down.
It goes down. All right. So you can see the impact of shifts in the yield curve and inflation expectations on the value of equities, bonds, and real estate. So there is a direct impact on expected returns and cost of capital due to shifts in the yield curve. So the first thing you're going to do in estimating the cost of capital that you're going to use to come up with the discount rate is you're going to do a forward curve and try to figure out where interest rates are going to go within the year. Okay? So you got to run the macroeconomic analysis and figure out where the yield curve is going to be. So the second thing we need to do is to figure out the cost of capital, because what we're going to do is we're going to raise capital in the stock market, in the equity market, and we're going to raise capital in the debt market. So we're going to use both stock and bonds for the acquisition that we're going to make. Okay? So we're going to raise, can IBM raise billions of dollars? It's through stock and bond issuance. Do they raise stocks and bonds in the marketplace and get the capital, make the acquisition pretty quickly?
Yes.
Yeah, they can, because they're huge. So we're going to go to the capital markets and we're going to raise the money and we're going to invest it in the company, and obviously the return on the investment is going to be higher than our cost of capital. Okay? But we got to come up with the cost of capital. And again, I did hear from a bunch of my students that when they read the chapters in the book, it makes it easier to follow me. So I highly recommend that you read the chapters in the book. It'll make it easier and quicker. You'll be able to assimilate a lot quicker. And I do have it on video too. So the first thing we need to do is we got to come up with the cost of the debt. Okay? Okay, so the first thing we need to do is come up with the cost of the debt. All right. So how do we build the cost of debt? What's the first thing we do? So I'm trying to figure out the percentage. I want the cost of the debt. So how do I build the cost of the debt that we're going to need to issue these bonds at? I got to figure out how much it's going to cost us in capital to raise the debt portion, because we're going to do both stocks and bonds. So what's the first variable, first component within the cost of debt calculation? What's the first variable? Any guess?
Your cash flows?
No, what would be the base rate? We're not talking in dollar terms, we're talking cost of capital. Okay? Expected cost of capital. Expected cost of the debt. So what would be the first variable, the base rate, in which we would put there to be able to estimate the cost of the debt? No, that's not the payment. It's in percentage terms. What's the very first rate that we would tack on as a base rate to start building the discount rate? Start building the cost of debt. What's the first rate? Also called the risk-free rate. Okay? So we're going to use, first we're going to look at the risk-free rate. Oh, and did I tell you that we're going to issue 7-year bonds? We're going to use 7-year bonds to raise capital using 7-year maturities. Okay? So what's the first, what interest rate would we use? What treasury yield would we use? If we assume that we're going to issue 7-year bonds. What risk-free rate are we going to use? What yield to maturity are we going to use? What interest rate are we going to use?
The yield curve interest rate.
Yeah, which one? What maturity am I going to use?
10-year.
But it's going to, we're issuing 7-year bonds. 7-year bonds. What bond would I go look at? What U.S. Treasury yield by maturity would I go look at if we're going to issue 7-year bonds? What? No. 7. 7. Okay. So 7-year. And where's the 7-year Treasury yielding right now? We're basically building a discount rate. You could be asked to do this. I've been asked to do this. I didn't know how to do it, so I'm teaching you how to do it. So where's the 10-year Treasury yield yielding today? You can look it up, don't be scared.
1.76.
Okay, 1.7. Got it. Okay, can IBM borrow at the risk-free rate? Can IBM borrow at the risk-free rate? It's either yes or no. You got a 50-50 chance of being right or wrong. Can it borrow at the risk-free rate? No, it cannot. Does it have a central bank where it can print money and basically pay the coupon interest on the bonds and pay the principal back? Does IBM have a printing press? No, it does not. Okay. So we have to add some risk premiums onto this corporate bond issue to take into consideration risk that the corporate bonds have that sovereign bonds do not have. So what's the #1 risk premium that's the most important that we would want to tack on first? And remember, this is a corporate bond, this is not a sovereign bond. So what type of risk do corporate bonds have that sovereign bonds do not have? What?
Bankruptcy.
Yeah, default risk premiums. So credit, default, risk premium. Okay. Any other risk premiums that we would want to tack on to this bond issue? Is this a short-term bond, a medium-term, or a long-term bond? It's a medium-term bond. So which ones are more risky, long-term bonds or short-term bonds? Which ones are going to be more risky, long-term or short-term?
Short-term.
So what bond has more, we'll look at a 2-year bond and a 10-year bond, okay? And let's say that the coupons are paid biannually. How many compound periods are there in a 2-year bond? How many compound periods?
2.
Are in a 2-year bond? 4. Okay. How many compound periods are there in a 10-year bond? 20. Okay. Which one is subjected most to discount factors? Longer one. Okay. So what bond is going to be more sensitive to movements in interest rates?
The short-term.
The 10-year bond or the short-term bond? The 10-year bond. It's going to be more sensitive to movements in interest rates. The price elasticity, also called duration, for long-term bonds is more than short-term bonds. And are we issuing a longer-term bond or a shorter-term bond? Longer-term or shorter-term?
Shorter-term.
Are we issuing a longer-term bond or a shorter-term bond? It's a longer-term bond. Okay, we're not issuing a 1-year bond or a 90-day or 30-day commercial paper. We are issuing a 7-year bond, okay, which would be a longer-term, medium-term bond. Okay, so it's going to have more risk to it. So wouldn't we want to tack on a maturity risk premium on top of that because it is a longer-term bond? Yeah. So we're gonna tack on a maturity risk premium. Now, which bonds are more liquid? Government bonds or corporate bonds?
Corporate.
Which ones are more liquid? Well, the US Treasury market is around 19 trillion. I don't think that IBM has a bond market of 19 trillion. So which one is more liquid, the government bond market or the corporate bond market?
Government bond.
The government bond market. So would there be a higher illiquidity risk premium, or would you want to tack on an illiquidity risk premium on the corporate bond?
Yes.
And which bonds are more liquid? Shorter term bonds or longer term bonds? Which ones are more liquid? Short term or long term? Short term. Short term, because they roll over quicker. Okay. Are any other risk premiums that we want to tack on? Is IBM a multinational corporation? Does IBM sell in the global markets?
Yes.
Yes, they do. What type of risk would they be subjected to?
Inflation,
If they sell into the global markets?
currency depreciation.
Yeah, currency risk, FX. Are corporate bonds, the interest that corporate bonds pay, are they subjected to taxes? The interest that you receive, is it taxed? Yes, it is. Okay, so are you subjected to tax risk? Yeah, you are. Are there other risk premiums that are probably out there that you want to tack onto this bond if you're doing a corporate bond issue? Would there be other risk premiums?
Yes.
Yeah, probably, but we don't know what those are. Okay, so we know what the risk-free rate is. So give me the risk premiums in basis points that we would want to tack on to the base rate to come up with the cost of the debt. So how many percentage points or basis points that we would add onto the base rate, credit default risk premium, maturity, illiquidity, and maybe you want to do an FX and a tax risk premium, but I need some numbers. And we know that the credit default risk premium is the largest risk premium of them all. So give me some numbers. Okay, hurry, hurry. I got 28 people that are working for me and I'm not hearing anything. I'm not even gonna run out of time. So give me some numbers. How much risk premium do I add on to the base rate for the credit default risk premium? How many basis points? What?
1.3%.
Okay. And then what about maturity? This is the way it works, okay? I need feedback, okay? Free riders don't say anything, okay? They just ride on everybody else's coattails. It's gotta be interactive, okay? This is the way it goes on in the corporate world, is we're all basically coming up with solutions really quickly because time is our enemy.
Does
So
maturity have to do with futures?
This is the maturity of the bond. We know that long-dated bonds are more risky than short-dated bonds. This is a 7-year bond. So how many basis points would I tack on to the risk-free rate to reflect the maturity risk premium?
Is it 1.2%?
I'll take it because nobody's saying anything. And that's actually a little large, okay? And it's obviously gotta be less than the credit default risk premium because this is the largest one.
Oh, wait,
Contributor.
1.2% was for a 10-year bond.
No, I don't care about the risk-free rate, I'm talking about the risk premium that I would tack onto the base rate to reflect the maturity risk premium. So how many basis points would I tack on? We know it's gotta be less than 1.3, so give me a number. Anything's better than nothing. Okay?
1%.
Nothing doesn't solve anything for me, what?
1%.
Okay. What about illiquidity? Think about it, okay? Don't just throw out numbers. Give me a number, please. We're running out of time. I need to get through the whole lecture, so give me a number, please. Give me a number.
0.08%, or 0.8%.
And what about any FX or tax? Anybody want to add any FX or tax? Okay, so what is 1.7 plus 1.3 plus 1 plus 0.8 to give us an estimated cost of debt on this new issue that we're going to use?
4.8.
What is it?
4.8. 4.8.
Okay, 4.8, so roughly 5%. All right, done. So now we need to come up with the cost of equity. All right. All right. So how do we come up with the cost of equity? What model do we use to come up with the cost of equity? What model do we use? Hey, you're gonna be working with the investment bankers, so they're gonna tell you what they're gonna use. And they're gonna use a model that we've already gone over. Does anybody know what model that we would use to come up with the cost of equity? What is it? No, that's the return on equity. That's not the cost of equity. But that's one way of doing it. You can probably do it that way, but that's not really the right one. Anybody else?
Capital.
You're close. Say it.
CAPM.
Nice job. And what is CAPM mean? Can you give me the definition?
Capital asset pricing model.
Thank you. Excellent. And can you give me the model for the capital asset pricing model to come up with the estimated cost of equity? Can you give me the equation?
Is it dividends per share?
No. That's not the one I want to use. You can Google it, put it on your phone, you can figure it out, and give me the equation. You need to memorize this equation, because they're gonna ask you, I assume you know it. So what's CAPM? What's the equation?
Free rate.
Risk-free rate.
Okay, risk-free rate, what?
The beta security,
Plus the beta,
multiplied by the expected market return.
okay, return on the market,
Minus the risk.
minus the risk-free rate, okay, excellent. And actually, this right here is called the market risk premium. This equation right here is called the market price of risk. All right. So what risk-free rate are we using?
Yield curve, 7-year.
We're gonna use the 7-year. What's the 7-year treasury right now?
1.58.
What is it?
1.58.
Well, we didn't do that up here. We used what?
1.7.
1.7. Okay, so we got 1.7, and we know that this is 1.7. Okay, excellent. And then, what is the average return on the market for the S&P 500 over the last 10, 15, 20 years? What has been the average rate of return, annual rate of return on the S&P 500 index, which is the benchmark, for the last 10, 15, 20 years? Okay, thank you. What's the average rate of return on the benchmark index? Oh, is it 20? Is it 20? Is it 20?
No.
No, it's not 20. Is it 0? No. Has it been negative?
Yes.
Yes, it has been, but has the average been negative? Is the average negative?
No.
No. Is the average going to be more or less than the 7-year treasury? Is the stock market riskier than the treasury market? Yep. So don't you think that the rate of return is going to be higher than the treasury yield? Yeah. Okay. So it's got to be north of 2. You know it's not 20. So what's the midpoint between 2 and 20?
10.
Okay, here we go, 10. So if you know what it isn't, you can figure out what it is. And that's about right. So if you go back and you calculate the average rate of return on the S&P 500 going back to the next 10, 15, 20, 25 years, it's around 10%. All right. And we know that this is 1.7. So what is the market risk premium? What's the market risk premium? What's 10 minus 1.7? Do the math. What is it? What is it?
8.3.
Okay. 8.3. All right, excellent. Is IBM a big company?
Yes,
Yeah. Is it on the major stock exchange?
it is.
Yeah. Does it make up a significant portion of the S&P 500 and the Dow index?
Yes.
Yeah. Do you think that the total return on the IBM stock is highly correlated to the overall market? Do you think that the total return on IBM stock is highly related
Yes.
to the S&P 500? Okay.
Yes.
So what would you think the beta would be then?
Similar to the total return of the market.
Yeah, so it's gonna move with each other. So what would the beta be? Is the beta 20? Is it negative? Is it negative 20? Is it 2? Is it 0.5? Is it 1?
Would it be about 10?
Well, that means it's a startup company. When the total return on IBM stock moves 10 times
That's a lot.
the overall market. So what do you think? IBM's a big company, makes up a significant portion of the stock market indexes. What do you think the beta would be? Would the returns move with the market, less than the market, or more than the market?
With the market, say
Probably with
like
the market, so what would the beta be?
2 or 3%.
No, that means it moves 2 times. If IBM's return moves exactly with the market, then the beta is gonna be 1. So what's times 8.3?
8.3.
8.3. And what's 8.3 plus 1.7? So basically, our estimated cost of equity is 10%. Okay? Is the cost of the debt more or less than the cost of the equity? Is the cost of the debt more or less than the cost of the equity?
Less.
It's less, does that make sense? Should the cost of the debt be more or less than the cost of the equity? It should be less, right? Because you can tax deduct the interest on the bonds. The bonds have the first claims on the interest, paid interest. Anything that's left over after retained earnings goes to the shareholders. If the company goes into bankruptcy and liquidates the asset, the bondholders get the money first, the shareholders may not get anything. So basically, debt has a preferential treatment in the capital market, so therefore it's less risky, and the rates of return should be less than the cost of the equity. And the issuing costs to issue debt is cheaper than issuing equity. Okay, so that's a check right off the bat. All right, so we got the cost of the debt, we got the cost of the equity. Now we gotta figure out the weighted average cost of capital. And the way that we do that is we gotta look at the capital structure. And the way that you look at the capital structure of the firm, the capital structure is the liabilities, okay? How are the liabilities distributed to finance the assets of the company? What is the capital structure for the firm? Okay? And to do that, you gotta look at the balance sheet. And what's the balance sheet?
It's a financial statement.
Yeah, but what's on the balance sheet? What is it? Assets and liabilities. Are the assets and liabilities reported at the market value or the historical cost basis? Cost basis or market value? Market or cost? Market or cost? Do you mark to market the assets and the liabilities, or when you're reporting in the annual report the historical cost basis of the assets and the liabilities? Historical cost. Okay. And do assets have to equal liabilities?
Yes.
Are you sure?
Unless we're marking down
It's a
depreciation.
trick question. Do assets have to equal liabilities?
No.
Really, under the matching principle?
Yes.
Yes, they do. Okay. All right, excellent. And how are the assets and liabilities broken down on the balance sheet? I'm testing you,
By
financial.
liquidity,
Yeah, so what are they, how's it broken down?
you would have cash first.
So those are short term, medium term, long term. And how's the liabilities broken down? Same way, short term, medium term, long term. And what are we missing? What are we missing on the balance sheet?
Stockholders' equity.
Yeah, stockholders' equity. Okay, excellent. All right. And IBM is a big company, isn't it? Yeah, let's just say it's worth $100 billion. Just to get at, a number, it's pretty big. So $100 billion. All right. And then how are most industrial corporations capitalized? What is their capital structure? How does it look, what does it look like to finance the assets? How much is debt and how much is owner's equity on a percentage basis for most industrial corporations? Most companies will finance their assets using debt and equity in a proportion that will maximize the return on equity. How much is made up of bonds and how much is made up of stock? What's the capital structure?
Isn't it usually 30% bonds, 70%
Is
stock?
that right?
No,
Is it 30% bonds and 70% equity, or is it 30% equity and 70% bonds? Can you deduct the dividends on the, from the shares? Can you deduct the dividends?
yes.
Like you can deduct dividends?
No,
Pay
you
dividends?
cannot
I
deduct.
can I deduct the interest on the bonds? Yeah, are bonds more or less liquid than equity? Bonds are more liquid, aren't they? And if I go into bankruptcy, who gets the first claim on the assets?
Preferred.
Bondholders. And when I'm paying out the earnings, who gets the earnings first? The bondholders or the stockholders? Bondholders. So what am I gonna use, more or less debt? Am I gonna use more debt or less debt compared to equity? More
debt.
More debt, okay? So what's the, just logically, what's the capital structure for most industrial corporations?
70% bonds, 30% stock.
Yeah, it's gonna be like 70% bonds and 30% stock. All right. And then what's the distribution here? So we know that this is what, 30 billion, right? If we can just do the math. What's the distribution here? Are you gonna have more of your debt short-term or long-term? Is most of your debt gonna be short-term or long-term? Long-term, okay? So give me the percentages here for the 70 billion.
50, 30, 20.
50, 30, 20, is that right?
Maybe not.
No, that's already 10. So give me, adjust it. Give it to me again.
10, 20, 40?
Like that? Does that look right?
Yeah.
Yep, okay. So we'll go. All right. Now give me the assets. How would the assets be financed? Give me the numbers. Don't we want to match the maturities of the liabilities with the economic life of the assets? Yeah, so what would be the short term? What is it? 10 billion. Medium term, 20 billion. 70. Excellent. So now we know what the target and the optimal capital structure of the firm is, using the historical cost basis, using the balance sheet. Okay?
The target and the target optimal capital structure can be different depending on company. Like if
It
be
could.
different for like startups, right?
Could be for the firm,
Yeah.
could be for the peer group in the industry. But there's an optimal capital structure and a target capital structure that the firm targets, okay? Because what's the goal in managing the liabilities? What's your goal? As a CFO and a controller, what are you trying to do to the liabilities? What's your goal? Are you managing the liability side of the balance sheet? Does the CFO manage the liabilities? Does the CFO manage the liabilities?
Yes.
Yes, they do. Does the chief investment officer manage the assets? Yes, okay. So what's the goal of the chief investment officer in regards to investing in assets? What are they trying to do? What? Yeah, they want to accumulate more assets, but what's their goal? What's their number one goal?
Meet the liabilities.
No, we can do that too, but when I'm investing in an asset, what am I trying to do? What's my goal? Maximize return. So I want to maximize the internal rate of return on my assets. Okay? And what do I want to do in regards to the liabilities? Do I want to maximize the cost of the liabilities or minimize the cost of the liabilities? You want to what? Minimize. We want to minimize the weighted average cost of capital. Okay? So what do we want to maximize? We want to maximize the spread between the IRR on the assets and the weighted average cost of capital of the liabilities. So we want to maximize the spread in percentage terms. And if you look at spreads for different companies and peer groups and industries, if you can get 100 to 200 basis point spread between the weighted average IRR on your assets and the weighted average cost of capital of your liabilities, you are going to maximize the value of the shares. You're going to maximize the value of the company. That's it. That's the goal. That's the game. And what we can do is we can also multiply the historical cost basis of the assets or the market value of the assets to get the dollar internal rate of return contribution on the margin to the company. We can also calculate the historical cost basis or the market value of the liabilities times the weighted average cost of capital to get the dollar amount of the weighted average cost of capital. So we can calculate the dollar contribution or the dollar spread. This dollar spread is called economic value add. Or EVA. That's the goal. You want to maximize EVA. Now, the problem is in the book, there's no mention of EVA. There's a problem here. So the book is missing it. You'd probably get this in intermediate financial accounting, but it needs to be talked about right now. Okay, it's important. So when you're listening to CFOs on their conference calls to shareholders and the analysts, they're going to be talking about EVA contributions. And if you use the market value of the assets and the liabilities, it's called market value add, or MVA.
Excuse me.
That's the goal. So now what we can do is we can calculate the weighted average cost of capital, okay, which is going to be our discount rate to discount factor for cash flows. How much time do I got?
34 minutes.
So we know what the cost of the equity is, and what is it? What's the cost of the equity? The cost of the equity? 10%. And what's the weight for the equity? Using the historical cost basis. What's the weight in the capital structure? How much weight, how much equity are we using to finance the assets?
30%.
30%. Okay. All right. And then what's our cost of debt? What's the cost of debt? What is it? 5%. And do we want to use the tax shield? Because we can deduct the interest on the bonds. We want to use the tax shield. So what's the maximum tax, corporate tax for corporations? Because it's progressive up to a certain point, and obviously I've got IBM pays the maximum. What is it?
35.
Yeah, it's 35%. And then what's the weight of the debt? What's the weight of the debt? How much are we using of debt to finance the assets? 70%? So what is 5% times 1 minus 0.25 times 0.7? What does that give us? We know that this is 3%, right? So what's my cost of debt? What's my cost of debt? Because I need to get the WACC to get the discount rate. Can you pull out your calculators and calculate it for me? And then have other people do the calculations to verify and you confirm the right answers for me so I don't get down a rabbit hole.
2.275.
What is it?
2.275.
2.7, 2.3. So what's our weighted average cost of capital? What's the weighted average cost of capital? 5.3. That seems a little low to me. So to be conservative, if I take out the tax shield, am I more or less conservative? If I take out the tax shield, will the cost of the debt go up or down? If I
Go
take
up.
out the tax shield, will the cost of the
Will
debt
go
go
up.
up or down? It'll go up, okay? So am I gonna be more or less conservative? Am I gonna be more conservative or less conservative if I take out the tax shield?
Less conservative.
More conservative or less conservative?
More.
More conservative. So let's take out the tax shield and recalculate the cost of the debt for me, please. So what's 5% times 0.7?
3.5.
And 3.5, so it's gonna be 6.5? Right, so the WACC is gonna be, what, 6.5? 5, 7%, 5%. So now what I did was I just made some sensitivities. Okay? So basically the 5% was with the tax shield, 6.5 was without the tax shield, and then I rounded it up because who knows, maybe the beta's gonna go up, or the risk-free rate's gonna go up, or credit default risk premiums are gonna go up, so I'm gonna create sensitivities, okay? So what discount rate do you wanna use to discount back the cash flows in this acquisition that we're gonna make? What discount rate do you wanna use? 5, 6.5, or 7? You're the team, you're the acquisition team, I'm asking you. You gotta give me some feedback. No answer is not gonna work, I need an answer.
6.5,
6.5?
just to like be conservative on it.
All right, so now we got it. Okay, so let's go look at the acquisition. We've already come up with the discount rate. And we're gonna use a 5-year holding period.
Whose beeper is that?
Okay, can you just turn it off?
This thing?
Yeah, I probably ran out of memory.